All right. Hello, everybody. Let me see, only 1 minute late. Hope everyone's having a great day. We're going to go through a lot of stuff. I'm looking at everyone's names right now. I see a couple of people in our community already. So just if you've already bought the program, just know the level of trainings on all of these topics and many more are much deeper in the program, including all the work papers and tools, etc. But if you're looking for a refresher, this will be a little bit higher level, but we'll dive in deep to some of these subjects. So we're looking at personal liability and tax for cannabis investors. We're going to kind of hit a lot of topics, so I'm going to go pretty quick. I like to go through the whole slides, everything, plus cover our program in under an hour, because I know you all are super busy, just like I am. And so we're going to do kind of a deep dive into these three main areas: common cannabis and CBD entity structures, looking at tax codes and entity overview, and then also personal liability considerations, which is a topic that I think is often ignored, but we'll hit all that. The last, 15 minutes, I'll cover the Dope CFO program. So if you want information about that as well, I will toss that in. Here's me. I teach around the US. I've actually yesterday spent 3 hours on the AICPA planning committee for the 2023 cannabis conference. That will be in Boston in mid-August for 3 days this year. I'll be speaking there as well. Most of the other people on the committee with me are national firms. So I've been super excited to be a really big part of that committee over time. So hopefully see some of you there as well. This slide I keep, we put this in kind of at the end of COVID. We keep it up because it's still true. You may have seen there, knock something out. You may have seen that the back when Biden originally said he's going to ramp up the IRS just in general, more resources, more agents, et cetera, more audits. But in cannabis has a big target on their back. We talk about this every single year at the AICPA Cannabis Conference. And usually there's lots of attorneys there and people arguing cases before the IRS court. And there's just a big target on this industry's back. They get, I believe it's $4 for every cannabis audit versus $1 for a non-cannabis audit. So for a couple reasons, that makes sense if you're in the IRS shoes. Well, first off, our government obviously needs money since we're 31 trillion in debt at this point. So they've got to find money somewhere. Why not get it at the easiest place, since they are understaffed already at the IRS? Secondly, almost every audit, they did a sample audit a couple of years back. I think it was 85% of tax returns in cannabis were wrong. And of those 85% that were wrong, I mean, almost 100% of those were underreporting tax. And so they know they can just pick a cannabis company out of a hat, and more than likely they are going to win a lot of audit fees. Well, that's good news for us as accountants. We can scare these clients a little bit and let them know, hey, this is not something you want to fool around with. You want to take this seriously. You want to correctly minimize your tax, but you actually want to do it correctly, and not just play games with the IRS. That's going to result in more than likely fines, penalties, interest, maybe lawsuit, time. It's not a good thing. The industry last year, 2022, was actually a down year as an up year and a down year. Well, it was an up year in that more and more consumers actually want cannabis. Every year they do these Gallup polls they go back 50 years, and you can just see 50 years ago, we went from 7% of Americans wanted legal medical cannabis in 1970. Today, that number is about 90%. So the number that goes up every single year. So more and more consumers, basically all of us, 9 out of 10, we actually agree on something, want medical cannabis. On top of that, the science is now caught up, that there's actual scientific research on many ailments And so this market is going to grow. There is no stopping this movement at this point. 10 years ago, Colorado kind of took a risk and went legal. Here we are 10 years later. Hemp and CBD are fully legal now. They weren't back then. And cannabis is legal in some form in 47 states. And that's just in the US. It's exploded across the globe. It will continue. And the two main reasons why that is, one, we all want it. And when we all want something in America, it will happen. I like to say, even if 55% of us want something and we get our officials elected, we can often make changes, or 60%, but when we get to 90%, things will happen. And we've seen that happen. And then secondly, just the medical side. Yeah, we're aging across the globe. And that means we have more ailments, anxiety, sleep, pain, whatever, cancer. And these are good medicines that's being proven out. So that's going to grow exponentially. Even though less capital came in 2022, still we had more states and counties and cities opening up last year, and more going from medical to rec as well. And that just will continue until I think if you go 10 years out, you'll see something a little bit similar to, on the rec side, the alcohol industry, where we've got liquor stores and wineries and craft breweries and cocktail vodka makers and all that. We'll have that in cannabis as well, and not just beverages. We'll also have products and foods. And then on the medical side, you're going to see big pharma come in a big way and start putting these chemicals, CBD, CBN, CBG, THC, mixtures of these into many of our medicines. And that's just going to happen. Whether you want it to or not, it's going to happen. So I don't usually talk about the number. It's going to be very big. All right, probably too much time on that. Let's just dive into entity types. Yesterday, one of the guys at the national firm brought this up at the cannabis conference. He was like, I can't believe it. I was just in an event and I'm starting to hear attorneys out there pitching multi-entity structures to beat 280E again. I can't believe it. We already went through that 8 years ago. And we went through the Harborside case for many, many years to get to the end of that. But still today, bad advice is being pitched. Often could be consultants, could be attorneys, could be even CPAs or accountants. We tell our clients and prospects, and when we speak in the industry, be very careful who you listen to. C Corps, there's pros and cons. When you think of people opening startups in most different industries, oftentimes you'll see a lot of LLCs, but there's a lot of good reasons to go C Corps in this industry. One, it's easier for a capital raise. Corp rates used to be 35%, now they're down to 21%, so that's better. They're definitely better for asset protection. If the IRS does audit the company, the audit stays at the company, the entity level. They can't leak through to the owners of the company. They can't say, oh, hey, I see Joe's an owner. Let's just audit Joe separately from this cannabis audit. That can't happen. And there's a lot of investors that's actually very important to. They don't think it through when they pitch in $1 million to that LLC, but they sure think it through when the IRS shows up and says, hey, we decided to audit you, Joe or Sally. We also have potential 1202 capital gain at exit as well. Cons, double tax, corporate tax, and tax on dividends. Startups usually don't pay dividends, whether we're talking high tech, medical companies, cannabis companies. The name of the game, we're going to funnel all our capital into growth and revenues building. We're going to pay tax each year at the company level. We're going to reinvest profits, if there are any, into growth, and then we'll do an exit. And so the tax on dividends simply may never happen for many companies, so that you may get away from double taxation. Another cost, C Corps have maybe more legal documents to set up, board minutes, things like that as well. This last bullet, I thought that might happen. You can just erase that. That is not going to happen anytime soon. As a matter of fact, there's lots of people, investors, that I talk to that say, hey, we like gridlocking in Congress where it's neither Republicans or Democrats. They're always kind of in that 55% range, and things that makes it a little bit harder to move tax rates. So we're probably where we are for now on that side. Now in the LLCs, they've got some pros, potentially better on tax rates for non-cannabis companies. Cannabis companies, actually, you're probably not going to get a lot of those things that you might get in a non-cannabis. You get a single tax, only one level. They're very easy to set up and maintain as well with lower cost. Cons, you've got to look at reasonable compensation and self-employment tax issues. Many CEOs forget about this. Second bullet, super important. An IRS audit can leak to investor personal tax returns, and I have never found an investor that is happy now or would be happy if that happens. Another big issue is if you are an investor, and this isn't minority in the way you think of minority around other areas, this is minority. If you own less than 50%, you are a minority interest owner. That's what it's called. The other party has the majority, you're a minority interest. That means you have no control. You can't change the structure of the operating agreement. And so if you get a K1 at the end of the year and it says, hey, Sally, your K1 says you own 30% of this company and there's 100,000 of income that goes on your tax return, you're going to have to pay 30 grand in tax or whatever your tax is. And oh, by the way, we're not paying any dividends or distributions. You're out of luck. And not just this year, maybe 5 years in a row. I have dealt with this exact situation with an extremely angry investor that this had gone on for 4 years and he couldn't do anything. So really think through that. Operating agreements. We're not attorneys, but we can sure give advice. If I see an operating agreement without mandatory tax distributions on an LLC, I'm going to make sure they get it corrected. So we can be an advocate. Again, dope CFOs, what do we do? We help owners any way we can. Of course, accounting and tax, but if we need to give ideas and thoughts and input around legal, we will. Same on software, banking, insurance, etc. We want to be experts in everything. We hit that one. 199A is super complex. So if you have a company with LLC and 8 different investors, 199A is going to be different for all of them. It may benefit some more, benefit others not at all. As well, it's also more than likely harder to raise capital as well. And we already talked about the IRS liability. Now, multi-entity structures. In my own experience, I've seen at least in the last month 3 of these deals pop back up, and I'm like, oh my gosh, this reminds me of 2015. So I saw 2 different structures that had something like, I don't know, 60, 70 entities. And my immediate thought is, this is a total nightmare. There cannot possibly be a legitimate business reason for this kind of structure. So first off and foremost, let's look at pros. Potentially, you can get some better asset protection, separating, say, for example, you've got a dispensary, the real estate goes over in one entity, the dispensary license goes in the other entity. That can be a perfectly valid reason and a good reason. We see this in the non-cannabis world all the time. You know, someone owns the real estate, someone else owns the McDonald's, or someone else owns the Walgreens. It makes sense. Separate that real estate value from the business value. Could be easier to get banking if you're having banking issues. That's not as big of an issue anymore because there's tons of banking options now for cannabis companies. Maybe you'll lower some tax issues if you do it exactly right. I've never seen anyone doing this right, and if it's done wrong, more than likely it can backfire and end up in actually higher tax. That non-cannabis entity gets looped into 280E as part of the business as well. So it's very, very tricky on that. If you see any kind of startup that's a 5 to 10 million startup with more than 4 entities, I would be diving in very deep to find out why on earth do we have more than 4 entities. More than likely, they're trying to beat tax. Now, first off, say you have 10 entities. Well, and I tell them this, we're the accountants. You got to do 10 sets of books, 10 tax returns. Maybe we got consolidations. That's more cost. We're going to charge you a lot of money to maintain all those accounting books and records. You got more intercompany accounts, related party issues. It's harder to get audited. There's just lots and lots of issues to deal with. And it's definitely not a good reason to beat 280E. And that's always the reason I see this. Oh, we're going to beat 280E. It's just not a great idea. So be careful with this on your, if you see this on your clients. Okay, let's look at some documents and other entity issues. This is a good time. We've done some pros and cons. Let's look at this because we get this question all the time. What's the best entity structure? And a matter of fact, I love to get that question because for one, it tells me they haven't dove in, and because we also get this. Hey, we need a CFO. We already got our entity set up. We got 8 entities set up. And it's already done. I'm like, oh, great. Can I look at that? Oh, why'd you do this? Maybe we have to spend money and time to undo what they've already done and do it better, which they do not like to hear. But the correct answer is definitely it depends. There is no one size fits all because every scenario is different. Every state is different. Every structure just on who are the actual owners and investors. Do you have one, like I have had a client that was one owner and he was also the investor. And he was building out his dispensary kind of with his parents' help. More often than not, there might be a group, like I also worked at, say, High Five Farms. There were 4 owners that got together that launched the company. And then we got, I don't know, 40 investors, and then we got some warrant holders, and then we got some lenders, and then we had some stock option holders via employees. Our cap table was really complicated. I spent a ton of time managing that cap table and including legal documents, very, very costly as well. So be careful on that as well. But if you're bringing in a lot of investors, the simplest route is to go a C Corp. And it's even easier on the reporting. It's easier on the investors. They don't have to worry about K1s and tax situations. The company itself will be paying the tax. We need to know what amount's being raised. We also need to know the goals of every investor. I have seen many, many, many times, including last weekend. It's just amazing how often this occurs. Wealthy parents or grandparents, they're 60, 70, they've had a successful career, they're worth $20 million. And sure enough, it's always someone young, their son, their daughter, their nephew, whoever it is. Hey, I want to build a farm. Can you pop me 4 million, I'll get it started or whatever. So we see lots of this. And so these people are conflicted, even if it's just like even a parent and a kid, or a older individual and a younger individual that's a friend. So the older person may be very focused on asset protection. I need to protect this wealth that I've built over 50 years. The last thing I need to do is throw it down the drain into a cannabis company and play a bunch of games with the IRS and find myself in hot water. So we need to know who and what their goals are. The young kid may be like, oh, I'll push the envelope. I want to minimize tax or even do it incorrectly. I don't care. I don't have any assets to risk or whatever. Can we fund these owners' tax bills every year, even without distributions? Do the minority interest holders understand the lack of control as well? And we also need to look at what are the tax rates? Are there any trust issues or not? Down here at the bottom, again, we're not attorneys. There's lots and lots of issues around raising capital. First thing out of my mouth to any client is I want to make sure they have a really reputable corporate tax attorney. And I don't say, hey, are you a cannabis attorney? That's actually often bad advice. That means they're playing games and whatnot. I want a world-class corporate attorney that's used to raising capital for startups and setting up entities. Doesn't matter if they don't need to be a cannabis expert to raise capital or set up entities. Boom, there it is again. So other issues, some general notes. Startups sometimes will issue convertible notes, debt that can be converted to equity later, or safe agreements. Those are simple agreements for equity. But then those will put off the company valuation to a later date. If you don't have a way of raising money, if someone just writes you a check for shares, you've got to value the company. That can take a bunch of time. It can cost a lot of money. It will cost a lot of money. Shares can be sold as shares in a C Corp, or in an LLC, you sell member interest. Company valuation would be needed on. There's lots of legal documents, which I think we're going to look at. Yes, right here. So let's look at a C Corp, possible legal documents. And this is not a complete list. This is just many I've seen and many more. And it can be a real headache to the chat up here. There it is. If you have questions, by the way, just toss them so I can see them there. But all these legal docs it's not just like you sign a document and shove it in the drawer. They've got to be updated, many of them annually. We've got to have them organized. It can get very, very complex and messy quickly. And so we want to have all our ducks in a row. If we're the CFO, that is going to fall to us, making sure we've got the right legal documents and structures, et cetera. And the CEO's got good advice, but we're going to have, we're raising capital, term sheet, certificates of incorporation, funding documents, whether it's a convertible note agreement, safe document, preferred stock investment could have that. Definitely we'll have investor suitability questionnaire. Don't let your clients just say, oh yeah, my cousin gave me 200 grand. That's not good. There's regulation D, there's laws in the US to protect Aunt Sally from doing things like that. So don't let your client do that. Investors' right agreements, shareholder and board consents, subscription agreements, voter rights agreements. We've got to track all this inception and quarterly, and the cap table as well, which can become very complicated. LLCs, it's a little bit smaller. You may have your term sheet. You could have a lot depending on if it's a convertible note. That's going to end up being, and by the way, that's not just one document. So if you do a convertible note, you're going to have a series of documents and consents that go with that as well. You're also going to have that suitability questionnaire, et cetera. And again, we're still going to have to track this quarterly and as well as tax situations. Now, stock issued to employee or contractors, that can, again, be super complex. We did this actually at Hi-Fi Farms right before they went under, and it was a big nightmare and headache to deal with. But including a 409A company valuation at inception, we had to do that. Took a lot of time and money to get that done. Think of it as a mini audit. You got to do board and shareholder resolutions. You're going to have to set up a stock incentive plan. It's either going to be non-qualified stock or incentive. It's going to be very costly. There's lots of attorneys that will do this, and believe me, these kind of attorneys are not cheap. You'll also then have a notice of stock option grant. You'll have a stock option agreement. They'll have 83B elections. You have to update this constantly. You need to track if people are forfeiting shares or if they vested in their shares at different times, which shares are exercised. We also need to make sure the legal documents are always up to date and completely executed. It can get very messy if you're doing this with 20 or 50 employees. And again, maintain that cap table, which is a listing of owners and amounts, both current owners, and sometimes there's owners that can come in later. So if I give Sally 2% of the company and it vests over 4 years, that means right now today, she has 0 shares, but at the end of 4 years, she would have 2% if they're fully vested. And if she works a year and quits, she might have a different amount fully vested. But we always want to track what is going to be the fully diluted amount, assuming everyone gets all their shares. Also, the GAAP accounting and tax accounting is very complex on these kind of plans. So be very careful on that. LLCs, they can, down here at the very bottom, can issue equity or net profits interests. Be careful with those two. Net profits interests, I've done those. I've been given those and had them, and I've given them to managers, and they're very complicated and hard to track. It's not I would not recommend them at this point because just it's too complex. Tax codes and entity overview. So we've been talking about all these entity structures and ideas and documents. Just know that it is complex. So many owners, CEOs out there, especially in this space, think that, oh, they can just form an LLC on the internet and get all their buddies to give everyone pitch in 100 grand, and we don't need any legal documents, and let's set up 5 entities and go on down the way. Let's make sure they're doing things right. To start and run a cannabis company is a multi-million-dollar effort. You cannot run a good farm or manufacturing plant without millions of dollars, period. Same on dispensaries. Very, very costly, whether it's the real estate or the labor. you're going to have your clients investing lots and lots of money. And not only that, many of these companies will operate at a loss if they're doing 280E correctly. And even the big companies, go look at any of the public companies like Tilray or Cresco or whoever, they are losing amounts of money every quarter that you would not even believe how much they're losing. And they still have billion-dollar valuations or whatever. So it's a very capital intensive industry, especially if things are done right. 280E, the couple of very important words, basically your tax return, no deduction or credit. If a amount is paid or incurred, if that business is a trade or business that is trafficking. So trade or business is the most important words because that is very broad and it was intentionally done this way. And whenever a client wants to go down the whole multi-entity structure idea, I send them right to the Harborside case, and they talk about this specifically. This is not going to work. The IRS could not care less if you have one legal entity or 4,000, doesn't matter. They're going to come in and look at this from 10,000 feet, and they're going to say, we're in a helicopter above that. It looks like a farm to us. It looks like that farm is selling pot. You've got a trade or business. And just because you divided that farm into 20 entities does not mean that 19 of those entities are going to be non-cannabis. Again, 280 applies to a trade or business. So if you have 20 entities, you better have a very good explanation of why that is. Because if it's just to get out of tax, it will not work and can backfire. Another important word is trafficking. What is trafficking? Generally, for certain, if your client ever owns the plant, whether it's a farm, a dispensary, a manufacturer, a processing plant, gets a little more gray on service providers like delivery companies. A delivery company would be trafficking under the criminal code. There is more of a gray area under the tax code. So just let your clients beware. They're taking some risk if they own a delivery company. We're not certain. The courts have not ruled on that as of yet. 471, the good news for cannabis companies, no deductions or credits, but inventory is allowed. So you are allowed to, since inventory is not a deduction, it's not a credit, it's a return of capital, you are allowed to book cost into inventory. So for dispensaries, they're the worst hit by this. Basically, whatever they pay for the inventory is the cost. So if I go to the farm and I buy a pound of weed for $2,000 and I go back home and put it on the shelf, that inventory in my business is 2,000. And if I sell all that inventory for 3,000, my cost of goods sold is going to, once the inventory sold, is going to be 2,000. We can have, we can add some production to a product, but, and this example is out of date. Pre-roll will not qualify anymore. Early on that would. In Harborside, they came out recently and said, you really have to transform the nature of a product. So if you turn raw THC oil into a gummy bear, that's production. But if you simply grab some flour and roll a joint, that is not production. So we can't get away with that. So generally speaking, dispensaries are like all retailers in the US. You buy a product for $100, that's your inventory cost. For cultivators, processors, and manufacturers of products, including foods, beverages, lotions, tinctures, hundreds of products, we have good news. 471.11 allows us to put many costs in inventory, and that's good for us because when the inventory is sold, it becomes cost of goods sold, and that will lower their taxable income legally and correctly. That's what we like to tell our clients. Let's do it legally and correctly. Now, how do we do 471.11? It's complex as heck. You've got to have tools, work paper, systems, and knowledge to do this. Accrual, absorption, and costing is required. You can read about it right in the code if you want to go Google it. You need to be doing GAAP level cost accounting. If you're doing all that right, you can put all the direct costs, which is direct material and direct labor, plus 3 categories of indirect costs. Costs which can be included, things like rent and utilities, costs which can never be added to the inventory, things like advertising and selling costs, and then costs that can be added to inventory if and only if that taxpayer is doing this monthly in their recurring financials and in accordance with GAAP. We almost never see them doing this, and I tell them, hey, you're missing out. You're paying too much tax if you are not doing this GAAP level cost accounting. Let's come in and do GAAP level cost accounting for you. I'm going to be able to put more cost in inventory, things like factory admin, depreciation, other things that's going to save you money. And usually their eyes light up when they see that, and they're happy that we're going to come in and save them money the correct way, not the incorrect way. Finally, on tax, Section 199A, super duper complex after the 2017. So the 280E would apply to that. Say there's an LLC. Does that 280E flow through to the individuals? That's up for debate. Again, I would be super careful. I am not going to give a class on 199A. Just know if you're dealing with LLC and you're not a tax return preparer, you need to have a good tax return preparer on your team to help do that as well. Personal liability consideration. So there's many things on that side. Before I even dive into the seed to sale, one big piece of liability is just thinking. So if I'm going to invest in my son's CBD company, first off, let's just put on our risk mitigation hat. Does my son really know how to, he's worked at Target. Does he know how to be a CEO of a company? Probably not. That's a risk right there. But by me handing my investment dollars over to someone that's maybe not an experienced CEO, is that going to put me at more risk if something goes wrong? A current one in the news, it's not cannabis, but it's a similar industry, crypto. Sam Bankman-Fried and his parents, highly respected Stanford professors, attorneys, but they helped their son, create a nightmare. And are these parents now at risk? Maybe. I've heard they might be at risk because of this ridiculous thing called FTX. But that said, let's first and foremost, so I've consulted 2 different billionaires so far, and the first one was too late. I did help him get his $10 million back from literally a criminal operation. And my first question was, why on earth you have $1 billion? Why on earth are you investing in a $10 million dispensary when you don't need to? It's just risky. He's like, oh, my son, who's a musician, wanted to, and it makes him happy. So anyway, be careful of those kind of risks. Who's managing the company first and foremost? Seed to sale, kind of a side topic, but that's kind of that process where the state, this is related. The state uses seed to sale because, say I'm the state and the government, I want to make sure, I'm in Oregon, I want to make sure that if the industry is legal, that farm weed is tracked literally from the time it's planted in the ground all the way through the grow, the harvest stage, the drying stage, the curing stage, the trimming stage, off to the lab, over, then sold to the processor, then converted to oil, then sold to a manufacturer who makes those products, and then to the retailer, and finally to the delivery company, and then to the consumer. So you've got this big, massive seed to sale process, usually through anywhere from 3 to 10 entities over maybe a year. So from when that seed is planted to when someone actually smokes the pot or eats a gummy bear. And so they want to track that very closely, and they have lots of rules and regulations. So again, on the personal liability side, we want to protect ourselves, and the CEO and the investors want to protect themselves. So we need to be making sure we're doing a lot of compliance work as well. There's many sub niches. We want to make sure that not only the accounting and tax is done right, but we're in compliance with OSHA, EPA, FDA, USDA. It's a lot of rules. Oh, and by the way, state compliance. There's a rule book on every state, and guess what? It changes 2 or 3 times a year. So you need to follow those rules. What about your county rules and your city rules? You got to follow those too. If they don't have a compliance officer, you can either offer that in your services or bring that on as well. So we've got to really make sure we're following things so that we're not at risk. as the accountant or the CFO, we have so many issues to deal with. We could talk about this all day long. Some vendors won't serve the industry, whether it's accounting, POS, merchant services, payroll, insurance, we go on and on. Lack of tools outside of Dope CFO. We're going to be doing lots of cleanups. We've got to figure out how to use this state mandated seed to sale tracking software. There's only 3 that covers all 50 states, Metric, MJ Freeway, and BioTrack. I don't like any of them, but we got to deal with it. We've got to deal with lots of reporting requirements, consolidations, and complex entity structures, which we already talked about as well. Investor concerns. So if I put my investor hat on, because I've been kind of in all seats. I've been a CFO for 30 years. I've been a CEO or co-founder of a company, gosh, at least 10 times the last 20 years. I've been an investor in startups at least 10 times as well. And so I've worn all these hats. And so I have a good knowledge of what these issues are. The early investors, I was blown away as an investor myself at people just cutting checks left and right to ridiculous companies that had no controls, no governance, no nothing. MedMen's a great example. There's many others. You can just Google them all day long. I think investors now are getting more demanding and wanting to see better pitch decks and financial models, better controls and governance. We like to set up a perpetual data room that's available all the time and up to date all the time, so that we can have transparent access to our investments and know what's going on the inside. Investors also want to make sure taxes are done properly. They don't want to be exposed to the risk of their investment going into tax court. That can derail the whole company. Not to mention just if you lose, the fines and penalties, but just dealing with tax court for a couple of years can be a headache. You can also, what if you give a farm $1 million and that farm screws up their license or seed to sale reporting or whatever, and the state pulls the license? You just threw $1 million down the drain. So that's a big worry if I'm an investor. I'm going to also be worried about entity structure and good corporate attorneys doing the right thing. I want to have a minimized risk of audit failure, and I want to make darn sure we've got compliance taken care of. More than likely a compliance officer, or if not, it's on the CFO's radar. Our month-end tie-out system, we also call this the permanent audit trail. We want clients to be audit ready all the time, from startup and capital raise, but before there's even a company, all the way to exit. They're going to be raising millions of dollars. They're going to be spending millions of dollars. They're going to be growing, adding new dispensaries and farms. They're going to be doing M&A. Auditors are going to show up, whether it's from the state or OSHA or the IRS. They might need a gap audit for a loan. They're going to be raising new debt or new equity. They need audit ready books all the time, every single month. I've never found a cannabis company that has anything even close to audit ready. That's why we do it within Dope CFO for all our clients in this program. These are big companies, they're growing fast, and they simply need this as well. And again, if your books are not audit ready, you are definitely having value leak. And the first and foremost, your governance and controls will be weak. You're not going to have good world-class reporting. I tell people world-class reporting or any reporting, I don't care how pretty your software is or how many tabs your Excel file has, if that's built on crappy accounting, which it usually is, those reports are worthless. You can throw them in the garbage. Once we have great reporting, we can start looking at deep dives into improving cash flow, and definitely making sure our tax returns are done correctly. The permanent audit trail will go backwards and forwards all the way from the event or transaction through the source document. And there is always a source document, whether it's a legal document, an insurance policy, an invoice, a bank statement, whatever. And then we will tie that into the general ledger to our trial balance tie out with tick marks. And then from there into all our different reports. This is one tab of a 1 month. It's probably 50 tabs on this with tick marks and tie-outs. You can see it can get pretty complex, but it's ready because if I show up as the auditor, I can actually, this is like a trail of crumbs where I can go backwards or forwards and find anything I want, whether the accountant is around or not. The first bullet on this, I tell clients, you absolutely have to be counting inventory. So you've got lots of high value, small inventory, whether it's cash or a bud, a pot. And we have to be counting, if we're on the farm, we're counting our plants every single month. If we're in the dispensary, we're counting cash daily, every day, and tying it out to the POS and merchant services and the accounting system. We're also doing cycle counts every week in the inventory period. We've got to tie that out from our counts to the seed to sale system, to the POS system, to the accounting system. That's part of our permanent audit trail as well. And then from there, we'll add on that value add. We'll get our first and foremost, our key historical financials, the balance sheet, P&L, and statement of cash flows. But then from there, we can work forward with our KPIs, benchmarking, rolling cash forecasts, et cetera. Okay, let's not beat 280E. That shouldn't be the goal. I mean, the goal with any startup, I've dealt with startups again for a long, long time. Usually people want to rapidly grow a company, create a great product, and do an exit in 3 to 5 years. That's the same case here. And when they do an exit, they want to 10 to 50x, whether it's a VC, a private equity group, or a wealthy investor, they want a big return. So if you want a big return, the way to do that's not to play games with 280E via these first 3 bullets: complex entity structure, just throwing crap into cost of goods sold without any thought, or having small non-cannabis divisions and trying to allocate massive losses. None of those strategies will work, or any others. I've seen them all. Let's just do 280 right. Let's do our cost accounting. We can actually get a lot of cost into inventory for many of these companies. And by the way, valuations are going to be focused a lot of time in this industry on the brand, on the growth, on the revenues, on the locations if you're a retailer, and whether the company's losing money or not, including the public companies. They've had some pretty darn high valuations, losing a lot of money, and also being in compliance. Okay, if you're on the CFO side, be ready to go all in. There is no dipping your toes. This isn't something you do on the side. When we bring people that join Dope CFO program, we let them know, this is a great industry. It's super fun. It's growing insanely rapidly.